Hi, it's Nick Cato with Leo Barrick. On today's episode of Tax Concepts for Deal Professionals, we're going to be talking about shareholder loans. What are our shareholder loans? Well, let's assume you as the investor own stock in a U.S. corporation. If you follow me and have looked at my other videos, we talk about the tax implications of cash leaving a U.S. corporation to a non-U.S. investor and how there could be withholding taxes. Oftentimes, under a lot of the treaties or through special rules in the code, withholding taxes on interest can be reduced to 0% versus 30% on some dividends. Furthermore, when you repay the principal amount of a loan, that's not subject to withholding taxes. And then I guess more importantly, shareholder loans can also give rise to a tax deduction in the corporation, kind of reducing the cash taxes payable of that corporation. Now, there are a number of limitations around deducting interest on shareholder loans that we can cover in a different episode, but that is another benefit that needs to be thought through. And so, how do you set up a shareholder loan? And quite frankly, it's as simple as you're capitalizing your U.S. company, you're putting down some of the money in exchange for shares or equity in the business, and you're putting down some of the money in exchange for a note. That note is your shareholder loan. A lot of people will say, well, how do I size that shareholder loan? I'm doing my model right now. I'm paying a lot of withholding taxes. I want to pay a lot of cash taxes in the corporation. I want to put a shareholder loan in. So I'm going to make my shareholder loan 100% of my equity check. Does that work? And the answer to that question is no. In the US, in order to really respect the shareholder loan as debt for tax purposes, it needs to be arm's length. So that loan needs to really be made under terms that a third party would make. So you'd have to look at the debt to enterprise value, debt to EBITDA, all the other kind of DSCR ratios out there to make sure that that loan is reasonable in market, both in the quantum of the debt, plus the interest rate and the other terms that are applicable to the note. So that's something that we here at Leo Barrick can definitely help you with. And you can do an 80-20 approach if you needed to earlier on in the deal to see what would be a reasonable amount of debt to put on the business, and more importantly to see how impactful that is to your IRR. I've seen situations where it can be helpful, like very helpful, and I've seen situations where it could actually be hurtful. And so that's where modeling out the tax benefits of various planning opportunities is important. But more often than not, shareholder loans can be a powerful tool to reduce the cash tax drag to non-U.S. investors as they try to bring cash back across the border. That's it for now. Be sure to check out our other videos on our website or our YouTube channel. We cover a lot of different topics for deal professionals that I think you'll find very interesting.